This video is for informational purposes only and is not financial advice. Please do your own research before making any investment decisions. Investing returned almost 10% a year since 1900 based on the returns of global passive equity for a UK investor. Similar investment returns were achieved in other passive regional equity or property investments. For this video, I'll use the return on global passive equity of 9.7% because it's the most diversified and also my favorite investment. I'll explain why in a later video. Meanwhile, cash in the average easy access savings account here in the UK returned an estimated 4.1% a year over this period. Similarly, the short-term interest rate in the UK, which is considered a good approximation for savings rates, returned 4.3% a year.
If you shopped around, you would have achieved a higher rate than the 4.1%, so let's go with the 4.3% figure.
It's important to note that these figures are the annualised historic returns taken from over 100 years of historic data. Over shorter timescales, the picture is much more varied. Looking at the difference in returns over each one-year period of history, global passive equity was on top most of the time, but did lose out to the short-term interest rate 30% of the time. Looking at the 10-year period, there were a few instances where the short-term interest rate had a higher return, but 92% of the time, global passive equity was the winner, and this was often by a substantial amount. So, going back to the historic returns, we have to remember that these reflect long-term performance over 125 years. They are not a prediction of what will happen every time, but they are a powerful starting point for understanding the benefits of investing over the long term. So you might think investing is about 2 times better, because 9.7% is about twice that of 4.3%. If you had £100 in an account and achieved these average returns, then after 1 year you would get £4.3 or £9.7. In terms of your gain in money, that's about 2 times better. But there are 2 factors to take into account, which take investing from about twice as good to more than 30 times better. Let's take a look. First of all, let's take account of inflation. As we know, the things we need and want to buy are getting more expensive over time due to inflation. Thinking in terms of your ability to buy things, it's only the growth above inflation that makes you better off. This is known as your real growth. Inflation in the UK averaged 3.9% a year over the last 125 years, compounded annually. This means in real terms, you're only 0.4% better off using a bank account compared with 5.6% better off with investing. So thinking in real terms, investing now looks 14 times better. Let's look at this on a chart over time. As we saw before, if you started with £100, you would get either £4.3 or £9.7 more money after 1 year. But how much does this improve our ability to buy things? Let's say our weekly grocery shop currently costs £100. Due to inflation, we expect it to cost more next year. It's only our growth above inflation that makes us better off. So let's adjust this to be in real terms by dividing everything by inflation. In real terms, our investment growth is 14 times more than our savings account growth. How about our second factor? Our second factor is compounding. Have you heard of compounding? It's where your growth builds on previous growth over time. And over time, the difference in real growth compounds significantly. Growth at 5.6% a year compounds much faster than 0.4% a year. Let's wind the clock forward and take a look. After 30 years, the real growth of investing is 34 times better than a savings account, based on the historic returns of an investment in global passive equity. So, at first glance, investing might look 2 times better than a savings account. But once you factor in both inflation and compound real growth, it has been 30 times better on average over long time periods.